Should there be a banking crisis, the way it is going to be communicated to you is being planned. This is all about your right to know about a bail-in, which provides a bank who is on the brink of failure a resolution scheme. This is where customer deposits over and above the FDIC amount that is insured would be used to avoid a collapse. Lynette Zhang was on Kitco just a couple of days ago, and a short clip from the FDIC November meeting was played. I decided to view that 3-hour meeting and clipped a bit more, just about 15 minutes worth, so you can hear and see for yourself just how non-transparent they wish to be with the public. Have a listen.
At the end of the day, our ability to manage the orderly failure of a systemic financial institution will probably be the ultimate credibility test for our agency. And how our agency is viewed will be determined by how we handle that challenge, and our preparations to carry out that responsibility are absolutely central to what we do. In addition, we've been joined by several other distinguished new members. This will be their first meeting. Jay Clayton, the former chairman of the Securities and Exchange Commission.
I think one of the things that we should be really careful about is the next crisis won't be 2008. I don't know a lot. I just know that. I know that for sure. So, if I was sitting in your chairs, I would think, what is the seismic or systemic crisis that's not 2008? What happens if we get a major cyber event? What happens if we get a major cloud event? We could just go through these. And how do we deal with those events? And 2008, whether we like it or not, there was a sign, there was a windup, there was a pitch, there was a swing, there was a ball flying out. There were a lot of balls that went out of the stadium. We sat there and watched them. The next event, there may not be a sign, a windup, a pitch, and a ball. It just might happen. And so in many of these things, I think we've got to accelerate our thinking because we live in a highly accelerated world. We also live in binary outcome events. And the event most likely will affect multiple institutions simultaneously.
Yeah, look, I agree with what Gary said. And a question related to that, I think March 2020, it was sort of all hands on deck for a little bit with a little bit of, but not the same as 2008. I'm curious, when was the last time it was sort of all hands on deck for a resolution, even as an exercise? And I think that's, if it's been a long time, it's a good reason to, give it a try.
Well, I think 2020 was all hands on deck. I think the market events that we've had was all hands on deck. The geopolitical events we've had all hands on deck. A lot of some of the instances that we're going to share with you today are any one of these, to your point before, any one of these could cause a crisis amongst our banks. We need to be ready all the time, and we really don't know when it's going to come, and it could come very fast. So we do maintain a heightened state of readiness. We do exercises both internally and with other agencies and globally. We have protocols and committees set up to constantly work through some of these things. We can't predict it, and we try to build our resolution tools so that they're functional and they'll work in any sort of environment, but we really don't know what's going to happen. But we try to maintain heightened state of readiness.
And just to follow up on what Gary was saying, unfortunate experiences, every time you go through one of those, you're like, there's something I wish that I had, and that it would be interesting to get updates on what those things you identify that, we didn't have this going in, but we could use it the next time.
Yeah, just to amplify those comments as well, I think you have two things here to add. Big picture, how do we horizon scan in a more effective way? And how do we contemplate an economy that is substantially more open, right? You don't have the banking industry writ large as a choke point for the bulk of financial services delivery anymore. You've got open technology architecture, you've got open non-banks, you mentioned that a little bit. So as you think about continuing to shore up this section, which is super important, you know, it's sort of like a balloon. And the answer may or may not be, regulate more, expand powers. But how do you think about, how can we think about under the powers that, you know, you all have in collaboration with the other agencies to identify and address these types of risks as they emerge? Because in the end, people are going to care about, was the economy impacted by financial instability, regardless of where it came from?
What do we need to be thinking about for the stakeholders, the general public, customers, counterparties, other people like that? We think about what message do these stakeholders need to hear, and it might not all be the same. And then we think about when we need to be transparent. And I know that there's going to be a temptation for us to say, for people to say, FDIC should just lay it all out there. Say what you're going to do every step along the way. And that pre-commitment will help improve confidence. But we also need to be mindful of the need for FDIC to have operational flexibility to adjust to the specific facts and circumstances on the ground. So that if and when we do have to have that announcement on Friday night, ideally Friday night, that people are in a position to receive it, understand it, and say, yeah, that works. And we can see how this will happen. Of course, there will be doubters, but there's a lot of things going on.
I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis. And this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty-gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments. And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
So I'd like to take a slightly different view, and maybe a middle ground in the center. First of all, I think, Susan and Betsy, what you've done and the thoughtfulness here is extraordinary, and I want to give you respect for it. I do think there's more that could be put out in the public, perhaps not just on Title II, but also on Title I, in a way that isn't scary to folks. I mean, Gary, there's a timing question, right? We're at a delicate moment now. So if it goes out tomorrow, it might have a different impact than if if Susan and Betsy do their work and it goes out as we're moving out of the recession. But But I'm very big on transparency. I think transparency leads to accountability. The FDIC has to have flexibility. So there are some ways that you could get out some basics, which say, we could do this, we could do that. We will be holding these folks accountable. We have these powers, we have these authorities. Without putting too much out there. I get that we live in a tweet world, but you know that 1994 book that the FDIC did on this, I mean, that's a Bible, right? And so folks who want to know about it, want to know about it. One final thing is I think that there's an additional group of stakeholders that exist today that need to know more about resolution planning that didn't exist when we started on this journey. And that is the kind of fintech, non-bank lenders, money transmitters, digital assets, crypto exchanges, whatever we want to call them. I know you've listed domestic authorities, and I think there are states that are starting to think, should we have a resolution plan? And there's so much learning here that could be of benefit to those who are thinking about different kinds of resolution plans, and they would be very different if you could put a little bit out more in public. So I'd go for more, maybe not the whole hog.
You need to probably have on your website, and I know you have already a lot on this, how does Title II work? What can you expect from the institutions to do in case of a bit stylized? And this can go out on a normal sunny day. You need to be mindful that it doesn't go out and everyone scratches head why are they doing it now? But I think a number of the other topics are probably topics for, well, we would call it guidance paper, where you give more detail to those that have either an academic or an institutional desire to know, but they are not really top of priority for the public. Now,
I believe in transparency, but it has to have a meaning. So if the people that are getting the transparency need to be able to do something with it. So for example, when we have a terrorist alert and we give it a color, but we don't know where it is, how we respond, that's transparent, but not particularly productive, except that we should worry. So I think here we've got to do this sort of same sort of thinking. How and what should be used by the general public? And that's sort of minimal and sort of basic framework. And two, what transparency can you provide that will lend stability in a negative outcome? And that's more about not publishing, claimant communication. That's going to be more about, you're going to come out and say, we've got this, we've got a strategy for this, we are confident we can work through it. So that's sort of, I think, the way that you should be thinking about the communication. And with regard to accountability, yes, that's at some point, that's sort of a stage 2. I think you definitely need to do it, but that's not your first order communication. Your first order communication is, we've changed management, right? So those would be sort of a framework that I would offer up to think about, which I think you sort of have here.
It's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. And there may be some other prices. This is similar to what Jay was saying in the market, that you can tell whether people understand who's going to be protected, who isn't going to be protected. It would be, I think, an interesting study to look at the evolution of market prices in a situation like March of 2020, for example, and see whether people understood what might happen.
I might go further than that, Don, because I think that you look at the evolution, I think we have to sit down and talk to long-term debt investors and make sure that they, as a stakeholder group, fully understand bank debt today is not what it was before. It is not principal protected by design. And I think that expectation, I like how you started off, Betsy, like it's all about expectation setting. And I think that is absolutely critical. If that doesn't hold, this whole thing doesn't hold. And so I think it's one area to focus on. I do want to go back to something Jay said about stabilizing statements. In my experience, they're not stabilizing. If you have to make a stabilizing statement, you're in real trouble. And I think that part of that means that there's a lot of pre-work that needs to be done such that those statements aren't seen as a reach. Because if they're seen as a reach, the market sniffs that out in 2 seconds and actually has the opposite impact. And this is one of those big challenges, like what can be done ahead of time so that it's all going as planned, hands off the wheel. This is part of what we've been prepared for, because that's what builds confidence.
You just said very well what I was trying to say.